right, let's get right into it. Today, we're going to pop the hood on the US economy using the very latest official data. We're going to explore the massive, and I mean massive, forces that are shaping our financial world and what it all means for us. So, let's start with a number that is, well, it's pretty mind-boggling. As of the second quarter of 2025, the total net worth of U.S. households has rocketed to a record-breaking $176.3 trillion. Now, on the surface, that sounds incredible, right? Like a sign of amazing financial strength. But here's the thing. Does a giant number like that actually tell the whole story? Or are there maybe some cracks starting to form just beneath the surface? And that is the central question we're going to dig into today. And this really gets to the heart of our analysis. The U.S. financial system is a tale of two realities. It has this incredible resilience, for sure, but it is also showing some very clear signs of stress. You know, this quote from the source material just hits the nail on the head. We've got this strong foundation, this underlying resilience, but at the same time, you just can't ignore the warning lights that have started to flash. This is the main tension we're going to unpack. So to really get a grip on this, you have to think of the entire system like a giant balancing act. On one side of the scale, you have the net lenders, these are the savers, and on the other side, you've got the net borrowers. Let's meet the main players who are putting weight on each side. Okay, so here are our key players. You've got households who are the economy's primary savers. They consistently stash away more money than they spend. Then, on the other side of the scale, you have both the government and corporations. They're the net borrowers, always needing to raise more cash to fund everything they do. So just how much of a saver are we talking about when we say households? Well, every year, they generate a financial surplus of a whopping $1.9 trillion. This is the giant pool of cash that basically fuels the rest of the economy. And you'll see in a second why that exact number is so important. Because it's almost perfectly balanced by this number. The federal government is running a deficit of the exact same amount, $1.9 trillion a year. I mean, look at that. It's an incredible illustration of the imbalance. Pretty much all of the savings from households are being soaked up by government borrowing. Okay, so we've identified our savers and our borrowers. The next logical question is, how does that $1.9 trillion actually get from someone's savings account over to the government and to corporations? It's time to follow the money. Money really moves through three main highways. First, you've got the classic route. You put your savings in a bank, and the bank turns around and lends it out. Simple enough. But more and more, corporations are just going straight to the public markets to borrow. And finally, the government issues treasury bonds, selling them to basically anyone and everyone around the globe. And that brings us to a really important financial term, disintermediation. It sounds super complicated, but the idea is actually pretty simple. It just means corporations are cutting out the middleman, in this case, the bank, and borrowing their money directly from investors by selling bonds. It can be more efficient, sure, but it also makes them way more dependent on what investors are thinking and feeling. So this heavy reliance on borrowing, both by the government and by corporations, leads us straight to the two biggest, most towering risks in the whole system. The sheer amount of debt they've piled up is creating some serious vulnerabilities we really have to pay attention to. Let's start with the government's tab. The total outstanding U.S. Treasury debt is now sitting at an absolutely astonishing $28.5 trillion. To put that in perspective, that's gone up by over $2 trillion in just the last year. The scale is it's hard to wrap your head around. So who on earth holds all of this debt? Well, this chart breaks it down for us. Foreign investors are the biggest slice of the pie. But here's the crucial part to watch. That slice labeled monetary authority. That's the Federal Reserve. Their share has actually dropped from over 18% down to just 15.3% in the past year. What that means is the Fed is buying less, which puts more pressure on everybody else to pick up the slack. All right, now for risk number 2, corporate America. Corporate debt has now officially crossed the 50% mark. It's at 50.5% of total corporate net worth. That's a key red flag for high leverage. It basically means companies are carrying a ton of debt compared to their actual value. And remember that word disintermediation? Well, this chart is a perfect picture of it in action. You can see corporations have borrowed $7.7 trillion by selling bonds, debt securities on the open market. Compare that to just $4.9 trillion in good old-fashioned bank loans. It really confirms just how much they depend on the markets now. Okay, so we've laid out the big picture. You got massive government and corporate borrowing, and it's all being funded by household savings. So what in the world does this all mean for the markets? Let's take a look at what's happening. This slide shows one of the most powerful, game-changing trends in finance today. It's this huge rotation in how people invest their money. Look at this. Investors are pulling hundreds of billions of dollars out of those old-school actively managed funds, where a manager is picking stocks, and instead they're pouring it into passive ETFs that just track an index. It is a seismic shift in how America invests. So let's just boil this all down. For stocks, or equities, corporate buybacks are providing a huge floor of support. For government bonds, treasuries, that record supply and less buying from the Fed is putting upward pressure on interest rates. And for corporate bonds, all that leverage we talked about makes the whole sector super sensitive to those rising rates. All right, it's time to pull all these different threads together and make a final diagnosis. What's the overall health of the U.S. financial system? Well, all the data seems to point to a system that is, at its core, stable, but it's a stability that's under some pretty significant strain. And this slide really illustrates the fundamental issue. Think of the traditional pillars of stability, like the Federal Reserve and the banking system, as the economy's shock absorbers. The problem is they are being seriously tested by the immense weight of all this government and corporate debt. And here's the real kicker. One of those main shock absorbers is actually getting smaller. The Federal Reserve is actively pulling money out of the system. We're talking nearly $1 trillion over just the past year. It's a process called quantitative tightening, and it's like they're slowly draining some of the water out of the swimming pool, which makes financial conditions tighter and the whole system a little more fragile. So we are left with this really critical, forward-looking question. The data is pretty clear. The safety buffers, those shock absorbers, they're thinner than they were a year ago. The system's ability to handle a major shock has gone down, which really leaves all of us to wonder, what happens when the next real test comes?